For example, India sells to foreign countries and India buys from foreign countries as well. So selling to foreign countries called as export, buying from a foreign country is basically called as import. Okay, so you basically call all this as economic transactions. Selling to a country, when you sell goods to another country, you are receiving money. When you buy goods from foreign country, you have to pay money. So we keep a record of all such transactions. We keep a record of all such transactions. For example, record means you write it down. Okay, that's called as record. Okay. So whatever transactions that are taking place between India and foreign country, we systematically record it. Okay, and that record is basically called as balance of payments. Okay, all of you please watch this. Balance of payments. Okay, so balance of payments is nothing but a systematic record. What you record here, all the transactions that are happening between India and foreign countries, you record it here, you write it down here. And that systematic record of all the transactions taking place between residents of our country and foreign countries basically called as balance of payments. Okay, that's the first dimension for the sake of everybody's understanding. And you all are aware of the fact that balance of payments has two sides. Okay, one is left side, the other one is right side. This is the left side, this is the right side. Right, in left side, what you enter is credit. On the right side, what you enter is debit. Okay, so what do you mean by credit and debit as per balance of payments concept? Credit is also called as receipts. Okay, receipts, and debit is also called as payments. Okay, so please keep this in mind. Okay, what do you mean by receipts? All of you please understand this. Logically, I'm trying to get you connected to today's concept, even though I explained some of this. For example, when you export goods to foreign countries, all of you look at this. Export means what? Goods are going from your country to foreign country. When we export goods to foreign countries, I want all of you to know, foreign people pay money to us. So money is coming, foreign currency is coming to our country because foreigners are paying us. When we sell goods to foreigners, foreigners pay us foreign currency. So when money comes into our country, we record it on the credit side. So if money is coming from a foreign country to our country, it is recorded on the credit side of balance of payments, right? So it is, that's what's called as receipts. Receipts means we are receiving money. India is receiving foreign currency. That's what we enter in credit side of balance of payments. I hope all of you are clear with that. Are you all clear? Are you guys following me perfectly, everyone?
Yes, yes, sir.
Now, what is debit? For example, when we import goods, let's come back to import. What do you mean by import? Indians are buying from
foreign countries.
Indians are buying from foreign countries. When India is buying from foreign country, who has to pay whom?
India has to pay foreign countries.
Very good. India has to pay foreign countries. So is money going out of our country to foreign countries?
Yes.
So when money goes out of our country to foreign countries, you enter it on the debit side. Okay. So debit side is another payment. Payments means India is paying. So debit side is also called as payments. So whatever money comes into our country, it is recorded on the credit side. Whatever money goes out of our country, it's recorded on the debit side. That's how credit and debit of balance of payments is justified. I hope all of you are clear with what I explained. Are you all clear, my dear students, all of you?
Yes, sir.
Anybody
yes, sir.
okay, Dhruvi, is it clear? Dhruvi, can I have a response?
Yes, sir.
Right. Anybody having doubts, guys? Varun, Pratham, Ayush, Yesha, can I have your response, please?
No, sir, it's clear.
Okay. All right, guys. Okay, now look.
Yes, sir, got it, sir.
Got it. Okay, good. Okay, now I want all of you to please focus on this. Okay, now what do you mean by equilibrium? Okay, so equilibrium means this. Okay, all of you please watch me carefully. Equilibrium means this. Good, Pratham. Okay, now what do you mean by equilibrium? For example, your credits are, let's say, 1 lakh. I'm just taking a simple example. In a country, transactions go very huge, and debit also is 1 lakh. Can I call it as the amount of money received in the country is equivalent to the amount of money paid by the country to foreigners? Can I call it as 1 lakh is equivalent to 1 lakh? Can I take it like that?
Yes, sir.
Yes.
So we are receiving 1 lakh and paying how much?
1 lakh.
1 lakh.
So is credit and debit equal in this case?
Yes, sir.
So do you know what is called? What is this called as? You call this equilibrium. You know what is equilibrium? When credit is equal on the debit side of balance of payments account, it is called as equilibrium. It's called as balance of payments equilibrium. You call it as equilibrium because there's an equality between credit and debit. There's an equality between payments and receipts. But what I'm teaching you currently is disequilibrium. You know what is disequilibrium? Sometimes credits are more than debits. Credits are more than what? Debits.
Debits.
Is it matching?
No.
No. Sometimes debits are more than credits. Is it matching?
No.
When it is not matching, you call it as equilibrium or disequilibrium.
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 So you call it as disequilibrium. Now, credit more than debit is favorable disequilibrium, because your country is receiving more money than your country paying more money. For example, your country is receiving 5 lakhs, the country is only paying 3 lakhs. So we are getting more but paying less. So it is good for the country. You call it as favorable balance of payments. But you know what is unfavorable? When your debits are more than credits, you are paying 10 lakhs, you are paying 10 lakhs, but you're receiving only 7 lakhs. So the amount of money going out of your country is more than the amount of money coming into your country. So both are not balancing. So it is called as disequilibrium. And this is adverse, unfavorable balance of payments. Why? Because so much money is going outside your country, but little is coming into your country. So it's not good for the country. So much of money is going out of your country, but only little is coming into your country. This is disequilibrium. Debit is more, credit is less. It's unfavorable for the country. More money, more foreign currency is going out of your country, but less foreign currency is coming into your country. So you call this kind of disequilibrium as unfavorable disequilibrium, or it's called as adverse disequilibrium. Did I make it clear, guys? All of you are clear with what I explained?
Yes, sir.
Everyone can add your responses, please.
Yes, sir.
Yes, sir.
Yes, sir.
Okay, I want all of you to concentrate. Okay, whatever I'm teaching you are conceptual concepts. If you all listen carefully, it's very easy. Okay, so I just need your attendance like this every day so that I can make it easy for you. That's it. That's my only wish for all of you. Okay, now let's come back to the concept. So what I'm going to teach you today is measures to correct disequilibrium in the balance of payments. Measures to correct what?
Disequilibrium in the balance of payment.
When there is disequilibrium, should we correct it?
Yes.
So when the debits are more than credit, should we try to ensure that credits are more and debits are less? Is that our objective?
Yes.
Yes. So we should ensure that less money goes out of a country and more money comes into a country. Now, how to do that? How to do that is what we're going to learn basically under the topic called as measures to correct disequilibrium. How to increase our credits, how to decrease our debits, how to get more foreign currency into your country, and how to reduce the payments, money going out of your country, how to reduce it. That's what we're going to basically learn right now. Okay, so there are already specific measures which can be undertaken. Okay, so I want all of you to please concentrate on this perfectly. I will teach you specifically with examples. So I want all of you to kindly concentrate for better understanding. All of you, please concentrate. It's easy. I just want your concentration. Okay, now quickly tell me before I take you through this concept, just let me get you connected to this concept. Okay, all of you quickly, I want you to please answer to this question, all of you. I hope whatever is written here is clear for all of you. I'm just, okay. Can I have all those students who missed the previous classes to respond to these questions, please? Okay, now, okay, now look at this. I want 2 important logics to be understood clearly. Okay, what do you mean by export? Can one of you please respond? Exports. Exports means what?
Selling
Selling
goods.
goods to foreign countries.
To foreign countries.
Selling to whom? India is selling to whom?
Foreign
Foreign countries.
When India is selling to foreign currencies, so is money coming into a country?
Yes.
Yes. So if we export more, will more money come into our country?
Yes.
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 Should we export more to increase our credit side?
Yes.
So keep that in mind. Logically, I want all of you to keep that in mind. If you want more money to come into your country, export more goods. So always keep in mind, one good possibility of increasing the credit is export more. By exporting more foreign currency is going. So one way you can increase your credit, by increasing credit, you're going to it's good for the country. On the other hand, can you please respond, one of you? What do you mean by imports? Can you please respond? What do you mean by imports?
Buying of goods from foreign countries.
Buying of goods from foreign countries. That means we are buying, Indians are buying from foreign countries, yes or no?
Yes, sir.
Yes.
So if Indians are buying from foreigners, who's paying money to foreigners?
Indians.
Indians.
Where do you enter this? On the balance of payments, debit or credit side, if money is going out of your country?
Debit.
Debit.
So if we import more, it is good, or if we import less, it is good?
Import less.
But less.
Import less. If we import less, we'll be paying less money. Yes or no, my dear students?
Yes, sir.
So simple logic for everyone to keep in mind. Number one, increase the exports. If you increase the exports, our credit will increase. If you decrease the imports, our debits will decrease. And if we do this by increasing credit and decreasing debit, we can correct the disequilibrium, unfavorable disequilibrium. Yes or no, my dear students?
Yes, sir.
Are you all logically getting connected? Anybody wanting me to explain this further? Are you all clear, everyone? Labdi?
Yes, sir.
All right. Anybody having doubts?
No, sir.
Meet Man. Guys, are you all clear, everyone? Can I, okay, quickly tell me. So
Yes,
what?
sir.
Okay, logically simple. Should I increase exports or increase imports? Which one should you do to correct the disequilibrium?
Increase exports.
Increase exports and
Decrease the import.
decrease imports. Everyone clear? All of you?
Yes,
Yes.
sir.
Okay, so keep that logic in mind as I proceed explaining the further concepts. I want all of you to keep this simple logic in mind. The most important way by which we correct our disequilibrium is increase your exports, decrease your imports. By increasing exports, you can increase your credit. By decreasing your imports, you can decrease your debit or decrease your payments, and thereby you can correct your disequilibrium. So keeping that as a standard basic, as a base, let's go with the concepts to understand the measures to correct disequilibrium. Okay, logical. I want all of you please concentrate on this perfectly. Okay, what is the first measure? Can you please read this for me? I want to.
Depreciation.
Very good, Dhruvi. Depreciation. Okay. You know, I will explain this to you with the help of a small example, which I want all of you to kindly concentrate on. All of you. Perfectly concentrate on all of you. Okay, now when we talk about depreciation, we talk about depreciation in a currency. Okay, all of you, please concentrate on this small, simple numerical example. Okay, I want everybody to follow this. Yesterday I gave you a brief. Can I erase the screen? What is on the screen? Can I erase it?
Yes, sir.
Yes, sir.
Now look at this. What is depreciation? First of all, I'm explaining once again to you what is foreign exchange. Okay, you all should know very clearly what is foreign exchange, what is appreciation, and what is depreciation. So right now I'm going to focus on what is depreciation. Okay, I'm talking about exchange rate. Okay, what do you mean by exchange rate? First of all of you logically answer. Exchange rate is the rate at which one currency is exchanged with another currency. For example, $1 is equivalent to, let's say, 50 Indian rupees, close to 75 or 76. But let's take a small example. So $1 is going to how much? Let's go with the example that I've written on the screen right now. $1 is going to how much? How many Indian rupees?
50.
Okay, so the rate at which one currency is exchanged with another currency is called as what, my dear students? So how do you call it as?
Exchange rate.
Exchange rate.
Are you all clear with this logic?
Yes,
Yes,
sir.
sir.
Okay, now I'm going to teach you what is depreciation. Depreciation is a way to correct the disequilibrium. Now, what is depreciation? Logically, all of you should understand this in English terms or terminology, right? The meaning of the word depreciation means decrease in the value, right? That's how you study in accounts, right? Decrease in the value is depreciation, and appreciation is increase in the value. Yes or no, my dear students? Is that appreciation and depreciation in simplest of terms? In common
Yes.
man's language?
Yes, sir.
It's decrease in the value. And appreciation is?
Increase in the value.
Increase in the value. Okay, I'm just going to give you a very simple numerical example and how it's going to make an impact on exports and imports. So I want all of you to kindly concentrate. Okay, so all of you should understand this logically. For example, let's say $1 is equal to 50 Indian rupees is the exchange rate. What is the exchange rate? $1 is equal to 50
Rupees.
Indian rupees. So let's take an impact on imports. Okay, all of you please understand the impact on imports. Suppose, okay, you are a trader. Okay, assume that you are importing a good worth $10. How much you're importing?
$10.
$10.
$10 with 50 rupees as the exchange rate. How much should you pay for a $10 worth goods imported? How much should you be paying?
500 rupees.
500 rupees. Are you all with me? If you're importing a good worth $10, how much you should be paying in Indian rupees?
500.
500.
You know what is depreciation? Decrease in the value of our goods. Look at this. For example, $1 is equivalent to 60 Indian rupees is depreciation. Now you may ask me a question. Many students get confused with this concept. Sir, 50 to 60 is increase. Why is it depreciation? No, it is depreciation only, right? Why it's depreciation? while the figure has increased from 50 to 60, the value of Indian rupees has decreased. I'll show you a proof for this. What was the earlier exchange rate? Please read it for me. What was the earlier exchange rate? $1 is equal to 50.
Rupees.
Now, what is after depreciation? What is the exchange rate after depreciation?
60 rupees.
Now, to import the same $10 worth good, now how much you have to pay with the depreciation? How much you have to pay now?
600.
600.
Rupees. You are paying more of your currency because the value of your currency has decreased. That's why you have to pay more. Yes or no, my dear students? Is it logically right?
Yes, sir.
Earlier,
Yes,
you were
sir.
paying 500 rupees for the $10 worth good. But after depreciation, for the same $10 worth good, how much you are paying now?
600.
600. You know, I want all of you to understand. Now look at this. Is import, this is, how many of you got the concept of depreciation? Are you all clear with the concept of depreciation, my dear students? How many of you got this numerical example right?
Got
Got
it, sir.
Now tell me, suppose you're importing, how much you are paying earlier?
500.
Now how much you have to pay?
600.
Is import become expensive or becoming expensive or cheaper? Import.
Expensive.
When import becomes expensive, will you reduce or will people reduce imports or increase imports?
Reduce inputs.
Everyone? I want everybody's answers. When imports are becoming expensive, will people reduce imports or increasing imports?
Reduce.
So reduce imports. By reducing imports, can we correct that disequilibrium?
Yes.
Everyone? I told you, reduce imports, increase exports. You can correct the disequilibrium, yes or no?
Yes.
So
Yes, sir.
depreciation will make imports expensive. When imports become expensive, imports reduces. When imports reduces, payments reduces. So you can correct your disequilibrium. Clear with this, all of you?
Yes, sir.
So what's happening to imports because of depreciation? Is it decreasing or increasing?
Decreasing.
Decreasing. Everyone, is it increasing or decreasing because of depreciation?
Decreasing.
Decreasing.
Is it good to correct the balance of payments?
Yes.
Now look at this now. All of you look at this. Now let's look at it as an exporter. Okay, I want all of you to please respond to my questions. Okay, all of you. Earlier, exchange rate $1 is equal to how much? 15 Indian rupees. So if you're importing a good worth $10, how much you have to pay? Earlier exchange rate, as per earlier exchange rate, how much you have to pay?
500.
And now suppose you're an exporter. Now I'm talking about exports now, not imports. So if you're exporting a good worth $10 earlier, how much you are getting as an exporter?
500.
500.
Now, if you're exporting the same $10 worth good after depreciation, how much you'll be getting now as an exporter? How much you'll be getting now?
600.
Is it good for the exporters?
Yes.
So exports will increase. So look at this, because of depreciation, exports are going to increase, imports are going to decrease. So is it good for our country if exports are increasing and imports are decreasing?
Yes, sir.
That's how we can correct balance of basically balance of payment. How many of you got this example perfectly right? Are you all with me, everybody?
Yes, sir.
Yes, sir.
You're clear? You met him? You met him? Give me 2 minutes, please. Yeah. I'm sorry. Thank you for waiting. Okay, let's go to the next one. I hope all of you are clear with this and no confusion here. Okay, taking you back to the slide. Let's go to the next one. Please read the heading for me. What is the second measure to correct disequilibrium? Let's quickly. What is the second measure?
Import control.
What is import control? I told you one thing earlier. Should we reduce our imports?
Yes, sir.
To correct the disequilibrium, should we reduce our imports?
Yes.
Yes. Should we increase our exports? Everyone, I want everyone to respond. Should we increase our exports?
Yes.
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 Should we reduce our imports?
Yes.
So how to reduce our imports?
By import control.
Yeah, import control. So how to import? What is import control? Okay, look at this. There are two ways by which imports can be controlled. Number one, all of you look at this. Quotas, and number two, tariffs. All of you be very clear about it. There are two ways by which imports can be controlled by the government. Okay, number one is quota. Now, what do you mean by quota? It's like it's applying a quantitative restrictions. I'll just give you a very simple example. Assume that this is, let's say, assume that this is a person by the name X. Okay, this guy has imported, let's say 1 lakh units last year. How many units of goods did he import last year?
1 lakh.
1 lakh. Everyone, I want all of you to respond. How much did this guy import?
1 lakh.
1 lakh. Now the government tells that now this guy can only import 80% of what he has imported last year. It's a quota, it's a limit. So what is 80% of 1 lakh?
80,000 units.
So he will be able to import 80,000 units only this year, not 1 lakh units. So when government will set an upper limit, a quota, that's called as quota limit. Suppose, Divyanshi has imported 10 lakh worth goods last year, and the government tells this year you cannot, last year what you have imported, on that you can only import 70% of what you have imported last year. So obviously Divyanshi has to reduce her imports to 70%. So this is one way government can control the imports. Yes or no, my dear students? Is it logically right? Everybody?
Yes, sir.
Yes, sir.
Like second way by which import can be controlled is by tariff, import duties or tariffs. In simplest of words, is taxes. Do we have to pay a tax on imported goods?
Yes.
Yes. Right? We have to pay an import duty. We call it as custom duty. Right? Suppose the government increases the custom duties. Assume that you are this guy X. Right? And the government increases the custom duties. That means if you import, now you have to pay more taxes for imports. When government increases taxes for imports, will people reduce the imports?
Yes.
Everyone? When government increases the taxes for imports, will people reduce imports?
Yes.
Yes.
That's another way of controlling imports. But out of this, quotas are more effective. Sometimes when government increases taxes, people may reduce imports, may not reduce imports. But quotas for sure will reduce imports because government does a definite restriction on the number of goods that are going to be imported. But these are ways by which quotas and tariffs are ways by which the government can reduce the imports. And I told you earlier that reduction of imports can basically reduce the adverse balance of payments, disequilibrium. Did I make it clear, everybody? Can I have your response? Here, is it clear? Avi?
Yes, sir.
Ish? Ayush?
Yes, sir. Clear.
Anybody having doubts? Do you want me to explain this further?
No, sir.
Okay, let's go to the next one. I told you. What is the third measure? Read the heading for me, please.
Export promotion.
Export promotion. What is, like I told you, right? Either you decrease your imports or increase your exports. By increasing exports, will we receive more foreign currency?
Yes, sir.
Yes, sir.
So if we receive more foreign currency, will our credit increase?
Yes.
If our
Yes.
credit increases, can we correct the disequilibrium?
Yes.
Yes.
So how to do that? Export promotion. How can the government of our country increase our exports? You may be wondering, government is not increasing. Government can take measures to increase the exports of all the people in the country. Why our Prime Minister Shri Narendra Modi is going to foreign countries for trade reasons, my dear students. He wants to increase our exports, get more foreign currency, improve our balance of payments. Now, how to improve our exports? Government is not going to export everything. Even the private parties should export. But how to encourage the private people to export goods? Government can undertake various measures. I have listed a few. Okay. Number one, government can reduce export taxes. I want all of you to know it's not only for imports we have to pay taxes, even for exports we have to pay taxes. So it's a tax charge. So if government reduces export taxes, poor people will export goods. It's good for the country, yes or no?
Yes, sir.
Right. Number two is government can give cash assistance or subsidies. So government can give, suppose you are in an export oriented industry. So if government gives you financial assistance, it will encourage you to export more. So that's the second way by which exports can be encouraged is government can give cash assistance for exporters. Government can give subsidies for exporters. So when there's a financial benefit given by the government to the exporters, it will encourage exports, and more exports is good for the country. Third, look at the third interesting one. Certain goods meant for exports can be exempted from taxes, various taxes. For certain goods, the government will say no need to pay export taxes. Good, right? Will it encourage more exporters? The government is exempting from taxes, will it encourage more exporters, my dear students?
Yes, sir.
So that's another way of encouraging exports. And look at the fourth one, right? Effort should be made to encourage tourism. Tourism is a service sector, my dear students. If more and more foreigners are coming to India, foreigners are going to spend on Indian goods. So we are going to receive foreign currency. I repeat this once again. Tourism is a sector, it's an industry by itself. It's a service sector. If government is encouraging tourism, it means that more and more foreigners are going to come to India. When more and more foreigners come to India, they are going to spend foreign currency in India. So in other words, we are going to get foreign currency if more and more tourists visit India. So one way by which we can promote the exports is export tourism, encourage the tourism exports. Encourage foreigners to visit India, right? So these are ways by which we can increase the flow of foreign currency into our country, and that's why it's categorized under export promotion. Are you all clear, my dear students? Everybody clear?
Yes, sir.
All right. Anybody having doubts? Jansi, did you understand?
Yes, sir.
Anya, Ashika.
Yes, sir.
Yes, sir.
Okay, let's go to the next one. Okay, look at this. A very interesting one. Read the heading for me, please.
Production of import substitutes.
Production of import substitutes. Very good. What is import substitutes? I'll ask you a very simple logical question for which I want you to please think and answer. For example, this is India. India is buying machinery from Japan. India is buying machinery from Japan to manufacture cars. Indian companies are buying machinery from foreign countries to manufacture cars in India. Why are we buying from foreign countries? Why are we buying machines from foreign countries? Can I have your response, please? Because we don't have those machines in. Because those machines are not produced in India. That's why we are buying from foreign countries. Yes or no, my dear students? Is it simple, logical? Everyone, can I have your response?
Yes, sir.
We are buying machinery from foreign countries. We are buying technology from foreign countries due to a very simple reason. Because those goods, those machines are not available in India. So we are buying from foreign countries. You know what is production of import substitutes? It means this. Why don't you produce those machines in India? If you produce those machines in India, then you don't have to import it, yes or no?
Yes.
So that's called as production of import substitutes. Those goods that you are importing now, you start producing those goods in India. If you produce those goods in India, we don't have to import it. If we don't have to import, we don't have to pay. That's the meaning of production of import substitutes. So the reason as to why we import is because we don't have those goods available in our country. That's why we are importing. So what if we produce those goods in our own country? We don't have to import. And if we don't have to import, we are not going to pay. And that's going to correct our disequilibrium, my dear students. I hope I made myself clear. Are you all clear with what I explained, my dear students, all of you?
Yes.
Okay, let's go to the next one. Read this heading for me, please.
Fiscal policy.
Fiscal policy. Okay, we have learned a chapter called as fiscal policy. I taught you a chapter by the name fiscal policy. Okay, now what is this fiscal policy all about? Fiscal policy is a policy of the government mainly about taxation, my dear students, and public expenditure. And I wanted to please focus on this concept. Okay, taxation is a policy of the government. Fiscal policy is a policy of the government wherein government uses some instruments to achieve its objectives. Okay, I'm not going to the depth of fiscal policy, but I'll just tell you a simple logical connection. Suppose a person is earning an income of, let's say, 1 lakh. What is the income earned by the person? What is the income?
1 lakh.
1 lakh.
30% is the rate of taxes. Tell me how much he has to pay.
30,000.
How much tax he has to pay?
30,000.
So how much money he has to spend with him?
70,000.
20,000. Are you all with me, my dear students? All of you are clear with this example?
Yes, sir.
You know why people are importing more? This is called as disposable income. The amount of, see, if a person is getting an income of 1 lakh, he does not have all that 1 lakh to spend. He has to pay taxes from this. After minusing taxes, the remaining money is called as disposable income. That's the amount of money that can be used for spending. 1 lakh is not available for spending. Only 70,000 is available for spending, even though the income of the person is 1 lakh. Because out of 1 lakh, 30% has to be given as taxes. One of the reasons as to why people import more goods is because they have more disposable income. They have more money in their hands. So what government can do? Government can increase the taxes to 40%. Government can increase the taxes to what percent, my dear students?
40%.
What will be the available balance now after paying taxes?
60,000.
Disposable income in the hands of public decreases. When income of the public decreases, imports also will decrease, my dear students. You call it as fiscal policy. That basically in terms of taxation. Increase the taxes, people's consumption expenditure will automatically come down. If it comes down, imports will automatically come down. Today, Indian people are just buying so many foreign goods, leading to more payments going out of our country, right? And look at the last one is capital import. The last heading is what? Capital
Import.
What is capital import? Okay, balance of payments means what? Disequilibrium means what, my dear students? This is balance of payments. Balance of payments has two sides. One is called as credit, the other one is called as debit. So if money is coming into our country from a foreign country, if money is coming into our country, you enter it on the credit side, right? If money is going out of your country to foreign country, you enter it on the debit side. Yes or no? Is the picture right, all of you?
Yes, sir.
Okay. Now what am I trying to explain? Try to increase the credit. Yes or no?
Yes, sir.
You want to correct the disequilibrium, should you increase your credit, everyone?
Yes, sir.
Now how to do that? One option is capital import, my dear students. You know what is capital import? You can borrow money from foreign countries. Okay, look at the words here. You can borrow money from World Bank, International Monetary Fund, foreign governments. You can borrow money. Okay, I want all of you to understand this is borrowing. You are borrowing money from where? Can I have an answer, please? You're borrowing money from a foreign country. Even though you are borrowing, is money coming into a country? Yes or no? I want answers. Even though you are borrowing, is money coming into your country?
Yes, sir.
When money comes into your country, where do you enter it? Debit or the credit side?
Credit.
Credit side. So in case you have an adverse balance of if credit is less and debit is more, you can borrow money from foreign countries and then you can increase the credit. That's one way of increasing credit, borrowing. Not an advisable, because borrowing is not a good term, even though borrowing, money is coming into a country. So that's one temporary way of correcting our adverse balance of payments. The other way is like you can encourage foreigners to invest in our country. For example, encourage foreign people to buy Indian shares, encourage foreign people to buy Indian debentures, encourage foreigners to invest in Indian assets. So in that way also foreigners, that foreign money will come into our country. That is also capital import. And foreigners are investing in Indian shares, Indian debentures, Indian properties, Indian business. In all these cases, money is coming into our country. And when money comes into our country, it is entered on the credit side. So this basically, investments coming from foreign countries, borrowing from foreign countries, you call it as capital import. How do you call it as capital import? So one of the ways by which this, adverse balance of payments can be corrected is by going for capital imports. That's one way of correcting the balance of payments. It's a tentative measure, but it is a measure to correct the disequilibrium. I hope all of you are clear with what I explained. Dear students, did you all perfectly understand what I explained in this concept, capital imports?
Yes, sir.
Anybody having doubts? Can I have your responses, please? Varun, is it clear?
Yes, sir.
Man, Heer, Pratham, Isha.
Yes, sir.
All right. Okay, let's have a very quick review of the topics that we have focused on with respect to. Okay, I think I have missed out something called as exchange control. Okay, I'll finish with that. I thought I should start with the other chapter as well. So kindly do not miss the chapter that I'm going to teach you. Okay, I think I missed out one topic, exchange control. Yeah, here. Okay, I'll finish up this. Okay, all of you, please, what is exchange control? I'll picturize this for you. What is exchange control? Okay. Okay, look at this very carefully. I'm making India a little big. Okay, so that I can picturize it for you. Okay. You all know what is exports. Okay, I want all of you to please respond to my questions on exports. What do you mean by exports? Selling goods from India to
Foreign countries.
foreign country. What do you mean by imports?
Buying goods from foreign countries.
Buying goods from foreign countries. Okay, so I call this as imports, and I call this as exports. Okay, all of you should understand this. Okay, suppose. Okay, you all know the Indian Central Bank is called as Reserve Bank of India. What is the Indian Central Bank called as, my dear students?
Reserve Bank of India.
Very good, Reserve Bank of India. Do you know, suppose you are an exporter. Okay, all of you watch this very carefully. Suppose you are an exporter. Okay, you're just a moment. Suppose you're an exporter. Okay, and you're exporting goods. When you export goods, will you get foreign currency? When you export goods, will you get foreign currency, my dear students? Will money come into your country? This is you. You are exporting goods. Will you receive foreign currency? Yes or no? When you export goods, will foreign currency come into a country? Foreigners have to pay us, yes or no, when we export goods?
Yes, sir.
Yes.
So when money comes into our country, it's foreign currency. It's what currency is coming into our country?
Foreign currency.
This guy will have to give it to Reserve Bank of India and get it exchanged. He cannot keep it in terms of foreign currency. Right. So Reserve Bank of India, all the foreign currency should be given to the Reserve Bank of India. Similarly, a guy who's importing goods, now watch this very carefully, a guy who's importing goods, he has to pay money, right? So to pay money, he has to take foreign currencies from Reserve Bank of India and then pay to foreigners. So in other words, when foreign currencies are coming to Reserve Bank of India and foreign currencies are taken by importers from Reserve Bank of India, Reserve Bank of India will exactly have an idea how much foreign currency is coming, how much foreign currency is going out. So Reserve Bank of India will have a very clear-cut idea about the amount of foreign currencies coming in and going out. Based on that idea, the Reserve Bank of India takes certain measures. They will not give foreign currencies to everyone to import goods. For example, they'll give only to the ones who are licensed to import. They will not give license for people who are importing essential items, for example, unwanted items. They will not give license to ones who are importing luxuries. So the central bank will take measures to reduce the imports and exports based on them having an idea about how much foreign currency is coming in, how much foreign currency is going out. Based on that, they take certain policy measures to correct the disequilibrium. And you basically call this as export control, exchange control measures. I repeat the flow once again, just for 1 minute. Don't quit, all of you. Listen. This is an exporter. When he exports goods, is foreign currency coming into a country?
Yes.
That foreign currency cannot be kept as foreign currency. He has to exchange it with the Reserve Bank of India. So this guy, if he's getting $10,000, the $10,000 will have to be exchanged with Reserve Bank of India. Suppose this guy is importing goods worth $20,000. He has to take foreign currency from Reserve Bank and then pay to foreigners. So in other words, Reserve Bank of India will have an exact idea how much foreign currency is coming in, how much foreign currency is going out. Based on that, they take measures to control the imports and increase the exports. That's basically called as exchange control. Did I make it clear, guys? Is it clear, Ruby?
Yes, sir.
Ashika? Ashika left. Anya? Ayush, Pratham? Ruby?
Yes, sir.
You guys clear?
Yes, sir.
Tomorrow I'll be finishing up the national income aggregates. Okay, I need 2 classes to complete national income aggregates. So I want all of you to ensure that you don't miss tomorrow's class. In fact, from tomorrow on, please don't miss. I'm going to teach you something highly conceptual, highly interesting, simple. Tomorrow when you attend my class, I want you to please carry your notebooks and pens. You need to do some small simple formulas, which I assure you end of the class you will do it on your own without even studying. Okay, so book has a lot of explanation. You don't have to read all that. I'm going to make it as simple as possible for you. So kindly ensure that tomorrow you don't miss tomorrow's classes. I'm going to start with national income and national income aggregates. There are 2 conceptual chapters. We have numericals also from national income. So kindly do not miss the class. I will make it easy for you. I just want your attendance and your concentration. Right. Sorry, I thought I should take up that chapter a little bit as well, but I think the time didn't permit. Thank you so much, guys. I'll meet you again tomorrow. Have a good day, all of you.
Thank you, sir.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you, sir.
Thank you. Ayush. Thank you. David.